Brian, let's talk about income tax deductions, credits, and deferrals. First of all, define those three.
Yeah, the reason I have this one is because I hear all the time, oh, it's a tax write-off. Oh, those folks, it's a write-off for them. What do they care? Well, they care because it matters. There's a big difference between deferral, credit, tax exempt, all these different tax-free tax credits, all those things, they have different definitions. So I wanted to spend a little bit of time on that. First, income tax deduction. It's deductible. Well, that just means you're saving your marginal income tax rate. So let's say that you buy something for your business that's deductible, or make a charitable donation, it's deductible. Certainly for your business, there's no limits, but let's say your marginal tax bracket is 20% and you spend $1,000 on something. You don't get $1,000 back, you get the 20% back. So you get $200. So it made that expense $800 instead of $1,000 after taxes, because it was deductible. Let's say you make a charitable donation and that's deductible. Same thing applies unless you're below the standard deduction amount. So then it doesn't really do you any good at all. I'm not saying don't give to charity if it, certainly you shouldn't be giving it for tax purposes, but that's a consideration. So write-offs aren't as valuable. I remember when meals and entertainment, often were 50% deductible is all. So you spend $100 and you're in the 20% bracket, you got a $10 rebate on your taxes. So that's a deduction.
Out of deductions, credits, and deferrals, which is the most valuable and why?
Certainly credits are the most valuable. Credits are dollar for dollar. And so if you get a tax credit and you spent $1,000 on something and you get a tax credit for 100% tax credit on that, you actually get $1,000 back from the government. So credits are the best. Deferrals are an interesting area because a lot of people think deferrals are awesome, but we have to consider you're going to pay tax on that someday. So let's say you sell something at a gain and it's on an installment sale. You are going to pay tax on that as you collect principal. Here's another one, opportunity zones. People think, oh, they're great because you don't pay the tax. No, that's not the case. You will pay the tax, you're just deferring it for a period of time. And let's say you had a sale of something at a big gain and you put money into an opportunity zone. You're going to pay tax on that maybe in 6 years. But your new investment will be tax-free, and so that's another consideration. Like, for instance, gains from a Roth, tax-free. Gains from your life insurance can be tax-free. Gains from annuities are tax-deferred. Gains from your retirement accounts are tax-deferred. You're going to pay tax on it someday, or your heirs will. And certain things can get the step-up in basis, which makes them tax-free to people getting them. So again, tax-free, tax deferrals, putting it off. Tax credits, dollar for dollar. Tax deductions, depends on your marginal income tax bracket. So when we're talking taxes, it's a write-off. I kind of cringe sometimes because it's like, well, which kind of tax is it? And even 1031 exchanges, they're a deferral is all. Unless you pass away with it, you get the step up in basis, then they move to tax-free. So considering all of this, it's kind of hard to keep track of sometimes, but we do want to understand some of the differences between tax deductions, credits, deferrals, tax-free, tax-exempt, all of those different things.
And this is where being a CPA is so incredibly valuable in your profession, is knowing all this tax stuff. So I've always been under the impression that if I bought a computer for $600, that the $600 came off my adjusted gross income, but not necessarily the case.
Well, it might come off your AGI if you have a business, but your money back in your pocket will be a function of your marginal income tax bracket.
Brian, thanks for telling us more about these different tax categories.